Every single investor, from the novice to the seasoned pro, dreads a market crash. But here's the thing. While most people see it as a time to panic, we're going to break down the playbook for how you can turn that widespread fear into a rare, powerful opportunity.
So let me ask you a question. When the market absolutely goes into a free fall, what's the single biggest danger to your wealth? Is it the falling stock prices, the scary headlines flashing on the news, the state of the economy? Well, the real answer might surprise you. It's probably not what you're thinking.
Because the biggest threat isn't actually the market itself. No, it's the ancient, hardwired survival instincts that are rattling around inside your own brain. These are instincts perfectly designed to save you from, a saber-toothed tiger. But they are absolutely terrible for navigating modern financial markets.
But here is the good news. There's a way to fight back. So stick with me, because by the end of this explainer, you're going to have the exact, simple framework that elite investors use to master their own psychology and turn that market-wide fear into a generational opportunity. Okay, so first things first, we need to understand the enemy. And that enemy is right between your ears. It's the epic battle between our emotional, instinct-driven brain and the cool, rational logic you need for successful investing. When your portfolio starts dropping, your brain literally thinks you're being chased by a tiger. It goes into pure survival mode.
This brings us to a really core concept in behavioral science called loss aversion. What scientists have proven time and time again is that we humans feel the psychological pain of a loss about twice as intensely as we feel the pleasure from an equivalent gain. This is the scientific reason why seeing red in your portfolio feels so much worse than seeing green feels good. It's just wired into us.
And you can see it right here on this chart. The emotional sting from losing, say, $1,000. It's way, way bigger than the little kick you get from owning that same amount. This crazy imbalance is what primes us, what pushes us towards making the single most destructive decision any investor can make.
And the other major psychological trap that gets us is herd mentality. This is our deep, deep-seated instinct to just follow the crowd. We assume the group must know something we don't. It's a survival mechanism, right? Safety in numbers. Great for surviving in the wild. An absolute disaster for your wallet.
Think about it like this. You're visiting a new town, you're hungry, and you see two restaurants. One is packed with people, totally bustling. The other one is completely empty. Which one do you pick? Probably the busy one, right? That's herd mentality in action. Now imagine a market crash. Everyone is stampeding for the exits of the restaurant. Your brain is screaming at you to run with them, even if it's the worst possible move. So what is the real measurable cost of giving in to these primal instincts? And this isn't just, some fuzzy psychological theory. Researchers over at MIT actually put numbers to this. They quantified the staggering financial cost of what they call freaking out. And they had a really specific definition for what they called a panic sale. It's when a household sells off more than 90% of its stocks in a single month. We're not talking about just trimming a position here. This is a full-blown get-me-out-now, fear-driven liquidation. And the results? Just look at this number. A staggering 30.9% of investors who panic sold never came back to the market. Think about that. They turned a temporary paper loss into a permanent, real-life loss. And they missed out on the entire recovery that always, eventually comes. Okay, but what about the people who did manage to get back in eventually? What was the median return they earned after that panic sale? 0. A big fat 0. All that stress, all that anxiety, all that emotional turmoil, for literally nothing. It's the ultimate proof that panic selling is just a total loser's game. So this really gets to the heart of the matter in any market crash. And listen, it's not about the big guys versus the little guys. It's not institutions versus retail. It's all about mindset. It's the fundamental battle between the reactive herder and the disciplined contrarian. You really have two paths you can take. On one side, you've got the reactive herder. They see red on the screen, their brain screams danger, they follow that raw emotion, and they sell low, locking in those devastating losses. On the other side, you have the disciplined contrarian. They see the exact same red screen, but they perceive opportunity. They ignore the emotional noise, they follow a pre-written plan, and they systematically buy low. It's the exact same event, but two totally opposite reactions, leading to wildly different futures. And look, this isn't some newfangled idea. The master himself, Warren Buffett, nailed the entire contrarian philosophy with this one iconic quote. The whole game is about finding the courage and discipline to act rationally when everyone else around you is losing their minds. Okay, so that sounds great, right? Be greedy when others are fearful. But how do you actually pull that off when your brain is screaming at you to run for the hills? Well, the pros know a secret. They don't rely on willpower. Willpower fails. They rely on systems. So let's open up their playbook. And probably the most powerful yet simple tool in their playbook is something called dollar cost averaging, or DCA. The way it works is brilliant in its simplicity. You just invest a fixed amount of money, say $500, on a regular schedule, like every month. When prices are high, your $500 buys fewer shares. But when prices fall, during a crash, that same $500 automatically buys more shares. It forces you to buy low without ever having to think about it. It removes emotion from the equation entirely. And if you look at the legends, you see they all apply this core idea just in their own unique styles. You've got Warren Buffett, who uses crashes as his personal shopping spree to buy great companies when panic makes them cheap. You've got Peter Lynch, who famously saw a crash as a sale to load up on the amazing companies he'd already researched. And then there's Ray Dalio, who builds a portfolio so resilient and balanced that he barely has to make any decisions during the storm. See the pattern? Their specific tactics are different, but the foundation, discipline, preparation, it's exactly the same.
All right, this is it. This is what we've been building up to. We've talked about the psychology, we've talked about the philosophy of the greats. Now let's boil it all down into a super simple, actionable guide that you can use to prepare for the next downturn.
All right, first, let's talk about what not to do. Seriously, you should write these down. Number 1, do not panic sell. We've seen the data, it's the single most destructive thing you can do. 2, don't try to time the market. No one can consistently pick the bottom. 3, ignore the media hype. Their job is to sell clicks and provoke emotion, not to give you sound financial advice. And finally, don't use leverage. It's like pouring gasoline on a fire during a downturn.
Okay, so what should you do? First, stay calm. Take a breath and look at the financial plan you made when you were thinking clearly. Next, start seeing this as a sale. Go shopping for quality assets that are now available at a discount. 3, keep up your systematic investing, like that dollar cost averaging we talked about. And finally, rebalance. This is a great time to sell some assets that have held up well and buy more of what's been beaten down, bringing your portfolio back to its target. And this right here, might be the single most important thing to understand in this entire explainer. The work of surviving a crash, of actually thriving in it, it isn't done during the crash. It's done in the calm months and years before it ever happens. It's about having that plan written down. It's about knowing your own psychology. Preparation is the only real antidote to panic.
So in the end, a market crash isn't really chaos. It's a mechanism. It's a massive, predictable transfer of wealth. It's wealth moving from the accounts of the impatient and the panicked directly into the accounts of the patient and the prepared. By understanding your own brain and having a system in place, you get to decide which group you're in. The only question you have to ask yourself is, which side of that transfer are you going to be on?